Hello and welcome back. Remember how we talked about businesses in need of additional capital having two options to raise money that they need? The first is to go to a bank to prove their business potential and to obtain a loan, and the second would be to go to financial markets. Even within financial markets though, businesses can either issue stocks and bonds. Now that we know all this about stocks and how you can, or rather an investor can go about investing in stocks, let's shift our focus to bonds. So just like stocks, bonds are another way that a company can raise extra money that they might need to expand their business. For example, if a company has the need to raise, let's say, $1 million, in the same way they split a capital requirement into small shares and issue them as stocks, they can slice the $1 million into small units and issue them as bonds to the market. The main difference is that stocks are equities, and if you invest in a company's stock, you become a part of, or rather a part owner of that company. Bonds, on the other hand, are debts. So if you invest in bonds, it means you've given a loan to that company and they have to repay that amount plus an agreed interest to you. The reason companies go about debts instead of, let's say, a bank loan is because with bonds, companies can pay an interest rate lesser than what the banks require. So that takes a major cost element off for the companies. If we compare issuing bonds to issuing stocks, well, first, with the option of the bond, the companies don't really have to worry about how the company's ownership might be saturated, like in the case of stocks. Also, when a company issues stocks, the investors become part owners, meaning that the company becomes answerable to shareholders about what they do and, of course, why they do it. When a profit is made, it is expected that the company is to share this profit among all its shareholders. Companies don't have to deal with any of this when it comes to issuing bonds, and that's why they quite frankly do it. But companies are not the only entities that issue bonds. Governments and local government bodies like the municipal governments and government agencies also issue bonds. These entities issue bonds to raise monies, maybe to fund their budgetary deficits or to implement some of their planned projects like an infrastructural upgrade or anything of that sort. Sometimes bonds are issued for a specific cause as well. So for example, during World War II, the US federal government issued bonds just to raise money for welfare expenses. So depending on who has issued bonds, bonds can come in two forms: corporate bonds and, of course, government bonds, also known as treasury bonds. Even with government bonds, when a single governmental body issues bonds, like say a municipal council issues bonds, their bonds are called municipal bonds. And if any other government agents issue bonds, these bonds are called agency bonds. Now, let's look at bonds from an investor's perspective. So to begin with, it's common knowledge that stocks are the most popular type of investments, or rather investing, and gets more of the media coverage than investments themselves. We outlined and discussed this in our previous lessons as well. However, when it comes to market cap, the global bond market is actually larger than the global equity market. As of 2021, a report put out by the Securities Industry and Financial Market Association estimated that the global stock market valued at approximately $124.4 trillion. The global bonds market valued at $126.9 trillion. As for how bonds work as an investment, like I've said before, bonds function as a loan between an investor and the entity that issues the bond, which can be a company or a government. When an investor invests in a bond, they're essentially agreeing to give another member or another party a certain amount of money for a specific period of time. And in exchange, the receiving party or the bond issuing entity pays a periodic interest payment to the investor. Now, When the bond time frame ends, the issuing entity repays the full principal amount back to the investor. In other words, they essentially buy back the bonds. As an example, if you buy $1,000 worth of bonds paying 5% interest with a time period of, let's say, 10 years, the issuing entity really is agreeing to pay you an interest of 5% per annum on that $1,000 bond you bought. Then when the 10-year period is done, the issuing company returns that $1,000 back to you. Now, in the bond vocabulary, all these elements of bond investing have very specific technical terms which you need to know. So first of all, the 10-year time period that the bond came with is called the maturity. This is the date on which the bond issuer will return the money to the investor. Depending on the maturity, bonds can be categorized into three: short-term bonds, medium-term bonds, and of course long-term bonds. Now, short-term bonds are those that come into maturity with a period of up to 5 years. Medium bonds are those from 5 to 10 years, whereas long-term bonds are those with maturities of more than 10 years. The $1,000, which was how much the bond was issued at, is called the face value or the par value of the bond. More accurately, face value is the amount that a bond will be worth at maturity. Face value is also what the interest payments are calculated on. The interest rate of 5% in bond terms is called the coupon rate. It's the rate of interest that the bond issuer will be paying the bond holders. So in this example, since the bond's face value is $1,000 and the coupon rate is 5%, the bond issuer will be paying $50 a year to the investor for the next 10 years. Now, coupon rates can come as fixed or floating rates. If the coupon rate is a fixed rate, the interest stays the same throughout the bond's life. So if an investor buys a bond with a coupon rate of 5%, the investor will continue to receive interest of 5% each year until maturity. But if the bond rate is a floating rate, which is also called a variable rate, the coupon rate will be allowed to reset from time to time. Generally, floating coupon rates fluctuate only within a certain range, and the range in which the coupon rate will generally change will be made available to the investors beforehand. Anyways, regardless of how the coupon rate is designed, the interest payments are usually done every 6 months. But there's also a time when payments are done in other periodic cycles, like once a year, or once in 2 years, or even a single payment in the entire time of the maturity. So when an investor invests in a bond, the bond issuer will give a bond certificate, a physical or digital, mentioning all these informations like the face value, the coupon rate, and the maturity date as confirmation of the investor's bond ownership. Or they will simply record all this as a book entry, in which case the bond issuer doesn't give out a certificate but maintains records of the bond's specifics. Now, this being the fundamental way of how a bond works, some bonds work slightly different as well. So, for example, there's something called a zero coupon bond. Like the name says, zero coupon bonds don't pay an interest to the investor until maturity. But at the time of buying the bond, the bond will be bought at a price that is lesser than the face value of the bond. And at the time of maturity, the issuing entity will pay the full face value. So if there's a bond with a face value of, say, $1,000 with a maturity of 10 years, the investor might get to buy that bond at, let's say, $500. And when the 10 years are over, the issuing company will buy the bond back at the full $1,000, allowing the investor to make a return of $500. Then there are bonds called convertible bonds. Now, convertible bonds are applicable only to corporate issued bonds. So what happens is the issuing company gives the investor an option to convert the corporate bonds into shares of the company. This is kind of a great deal because this option allows an investor to have stable returns as well as the potential benefit upside of receiving stocks. Since this is relatively a much better deal, the coupon rates on convertible bonds tend to be relatively lower than on usual bonds. Then there are two bond types called callable bonds and puttable bonds. Callable bonds are bonds that are called back or bought back by the issuing entity before the bond matures. Puttable bonds, on the other hand, allow an investor to put or sell the bond back to the issuing entity before the bond matures. Anyway, regardless of the bond type, if an investor wants to buy or invest in newly issued bonds, just like stocks, they'll have to go to the primary market where they can buy the bond at what is called the offering price. Now, if it's a corporate bond, just like in the case of stocks and IPOs, accessing newly issued corporate bonds can be tricky for everyday investors like you and I. To gain access, investors will have to work with and have a good relationship with the investing bank or with the investment bank or the stockbroker who manages the primary bond offering. But in the case of government bonds, the access is far less complicated since the government sells their bonds directly for investors to buy either through designated treasury offices or through a designated or dedicated government website. This, of course, will differ from country to country, but this is how it's generally done. Both corporate bonds and government bonds, once they're issued on the primary market, start trading on the secondary market just like stocks do. This secondary market for bonds is what is called the bond market. So if an investor wants to sell off the bonds they hold before the bonds matures, the bond market is where they should go to. Now, this raises the question, at what price is a bond bought or sold on the bond market? So the first thing you need to know about bond pricing is the face value is not what is used as the price when bonds are bought or sold in the secondary market. The pricing happens in a very different way and is influenced by market forces which influence the prices for every other thing, demand and supply. Now, the demand and supply for bonds are driven by two predominant factors. The first one is the bond issuer's credit rating, and the second is the market interest rates. Now, if we talk about credit rating, bonds and especially corporate bonds are rated for their overall investment risk by credit rating agencies. Now, the ratings are based on the bond issuer's credit worthiness. In other words, it is the probability for the bond issuer repaying the debts in full to the investor on time. This credit worthiness is assessed by analyzing several elements, including the bond issuer's track record in repaying previous bonds and other debts, and when it's a corporate bond, by analyzing the company's cash flows against its debt obligations and the future prospect of the industry as well as the company. After assessing all these, the credit rating agencies issue a credit rating to each bond. Credit ratings are like grades in your exams. The rating is given based on how the company performs. The way the bond is rated varies from credit rating agency to credit rating agency. So, for example, the world's biggest and most referred independent credit rating agency includes Standard & Poor's Corporation, more popularly known as the S&P, Moody's Investor Services, and of course the Fitch Group. Just these three companies together control almost 80% of global rating businesses and 95% of the US rating business. These companies rate bonds like this. So all three agencies give a AAA rating for bonds of the highest grade. Then it starts varying. S&P and Fitch go AA+, AA, AA minus, A plus, A minus, and so on, while Moody's go AA1, AA2, AA3, A1, A2, and so on and so forth. As you can see, each credit rating demonstrates the grade of investment. AAA ratings and the next few rating grades essentially means that bonds of those ratings are very safe investments, but when the ratings hit S&P's A+, and Moody's A1, and Fitch's A+ and lower, it would mean that these bonds are safe, but not as safe as the high-grade ones, and the hierarchy works in its way all the way down. Now, B-grade bonds are again more risky than A-grade bonds, but less risky than C-grade bonds. So if you keep going down, those bonds tend to have substantial risks. The lowest C and D-grade bonds straight up communicate possible defaults. Ratings on a bond aren't fixed. They keep changing over time and how the climate surrounding that bond changes, especially with long-term bonds. Since a lot of the things can happen during interim years, so it really wouldn't make much sense to have a one-time rating. Anyway, the grade at which bonds are rated when the bonds are first issued affects the coupon rates of the bonds. So if a bond is rated at an A-grade bond, it means the risks associated with the bonds are less. Because the risks are less, the bond issuer sets a relatively lower coupon rate for these particular bonds. As the credit rating keeps getting lower, the coupon rates keeps getting higher because the bond issuer attempts to attract investors with better returns in lieu of the risks that are involved. So if you think about it, the whole thing aligns with the high risk, high returns, low risk, low returns mantra. When bonds trade on the bond market, the coupon rate of course won't change. That will stay relatively the same, but the price at which it is traded fluctuates as the credit ratings change. So if a bond rating drops, its price on the bond market declines because investors start to sell those investments. Because, come on, nobody wants to hold a high-risk investment, do they? Similarly, when a bond's rating improves, the bond's prices start increasing because investors start showing interest in that particular bond. So this is how credit ratings affect the prices of bonds. Then market interest rates are another factor. In fact, the most critical factor that affects the prices of bonds in the secondary market. So just think about this practically. For a bond to sell in the secondary market, it has to compete with every other bond that is being sold on that market, which is how everything pretty much works. Collectively though, every bond that is being traded on the bond market should compete with newly issued bonds and their newly issued coupon rates, which can be either higher or lower than the current market interest rates. To make this simpler, let's go back to our first bond example. So there's a $1,000 bond with a 5% coupon rate and a 10-year maturity. There's an investor, say Mark, who has invested in this bond and is getting an interest of 5% every year. Now, after 2 years, Mark decides to cash in on his bond and gets a $1,000 investment back through the secondary market. But during this time, there are newly issued $1,000 bonds that have come with a coupon rate of 6%. So realistically, an investor who might be okay to buy bonds will surely find the 6% bonds more attractive as opposed to Mark's 5% bond. So Mark wouldn't have any other choice but to sell his 5% bond at a now discounted rate. Now the real question is, at what price should Mark sell his bond? So to start with, Mark's discounted price for the 5% bond should compensate for the 6% bond that an investor will be foregoing. So the price should be lowered to a point where the 5% interest becomes 6% of the price paid by the investor. Okay, I know that just got you a slight bit confused, so let me break this down just for you. So the bond Mark has pays an interest of 5% per year, which is $50, meaning $50 is how much the bondholder would receive annually regardless of the price they pay for it. Now, to compete with the 6% market interest rate, Mark should set a price of his bond which is $50 interest, or rather at which the $50 interest would be 6% on the price paid. So if you work the math out, the bond price would be $833. So $833 is the price at which Mark should sell his bond. And at that price, the annual return of $50 will be a 6% return on the new bondholder's investment. If the opposite happened, where the market interest rates fall to 4%, Mark can get to sell his bond at a higher price since his bond pays more than what the current climate interest, or rather current climate of interest rates, does. So then he can sell his bond at, if you work the math out, is $1,250. So Mark can sell his now $1,000 bond for $1,250. Now, although conceptually correct, all this was an oversimplification of how bond pricing works. Of course, in the real world, many things are factored in when bond prices fluctuate in the bond market. But the point is, market interest rates and bond prices have an inverse relationship. When market interest rates increase, the coupon rates on new bonds also increase. This makes the lower rates on old bonds less attractive, causing the prices for older bonds to fall. And when the market interest rates fall, the old bonds with higher coupon rates become more attractive, making the prices on those bonds rise. In the bond market, when a bond is sold at a higher price than that of its face value, it's said that the bond is being sold at a premium. If the bond is sold at a lower price than its face value, it is being sold at a discount. Also, for some weird reason, the prices of bonds are generally quoted as a percentage of the bond's face value and are expressed as points. For example, if a discount bond is quoted at 85 points, it means that the specific bond is being traded at 85% of its face value. So if it's a $1,000 bond, that means the bond is being traded at $850. If a bond is being quoted at 105 points, that means the bond is being traded at $100, rather $1,050. These are just some bond investment slangs that you should know as well. Anyway, now if you take all this information and analyze it very closely, you'll see that there are two ways an investor can earn a return on bond investments. The first is the most obvious one, that is through interest incomes. These are stable and consistent payments made to bond investors on a regular basis. The second way is through capital gains. That's the money an investor makes when they sell their bonds at a premium. If the market interest rates go high, however, the investor will have to sell at a loss. This is basically all the introduction you need to understand bonds and investing in bonds before we dive deep into how to invest in bonds during a recession.